Welcome, everyone. I'm Brian Horrigan, and it is my privilege to be Dean of this great law school in its 58th year and to welcome you to this special event. As is now customary at Monash University, I wish to acknowledge the people of the Kulin Nations on whose unceded land we are gathered when we meet together at Clayton, from where I am speaking. I pay my respect to their elders, past, present and emerging, and also to the elders of the Indigenous people of other traditional lands from which people are joining this meeting throughout the world. It is my great pleasure to extend a very warm welcome to everyone in our audience today to the Bob Baxt AO Address in Corporate and Commercial Law. It is a particular pleasure to welcome our distinguished guest speaker, Professor John C. Coffey from Columbia Law School, who is joining us from New York. The late Professor Bob Baxt remains the only Australian in history to have been the head of an official regulator, a partner at two major law firms, and the dean of a major law school, Monash Law. Many in the audience today, including myself, will have worked with Bob Baxt, been mentored by him, attended one of the many seminars and workshops he led for the benefit of legal practitioners, business people and regulators, and benefited from the corporate competition and consumer laws that were far, far better because of his tireless public thought leadership and law reform submissions. We are proud to continue his legacy through academic and professional seminars and lectures, such as this special one today, as well as the establishment of the named chair in his honour at Monash Law Faculty, the Bob Baxt AO Chair in Corporate and Commercial Law, held by Professor Jennifer Hill, who will speak shortly, the Director of our Centre for Commercial Law and Regulatory Studies, as the inaugural holder of this prestigious professorial chair in honour of the late Professor Bob Baxt. Professor Coffey, we are delighted that you are able to give the first of these addresses in memory of Bob Baxt. I know it will be a wonderful beginning to what will become an annual event in the years to come. We are delighted to welcome Bob's wife, Ruth, to this event. When Ruth heard, Professor Coffey, that you would be the inaugural speaker, she expressed how pleased she was because she knew that Bob knew you and greatly admired you. At this point, it is my privilege to ask Professor the Honourable Marilyn Warren, ACQC, to say a few words about Bob Baxt and the very special place he holds in the Monash Law's history. For those members of our audience who are overseas and might not know Professor Warren personally, she is a Monash University Vice-Chancellor's Professorial Fellow. She served as Chief Justice of the Victorian Supreme Court from 2003 to 2017, and she is one of our most distinguished judicial alumni. It is now my great privilege to welcome Professor Marilyn Warren.
Thank you very much, Dean, and good morning and good evening wherever you are coming to this marvellous seminar today. It is indeed a privilege and a pleasure for me to be able to give some remarks about a dear and much admired colleague and friend, Bob Baxt. Bob was born in Shanghai, China, came to Australia and graduated from both Sydney and Harvard universities. He rose to be the Dean of the Faculty of Law of Monash University, a seat he held for a period of 8 years from 1980 to 1988. He was then a partner of one of Australia's leading law firms, Allens Arthur Robinson, from 1991 to 2004, a period of 13 years. He was later Emeritus Partner of Herbert Smith Freehills from 2005. He was, wherever he went, but in particular at those law firms, a much loved and admired colleague. He never stopped working in the field of corporations and commercial law. He was fascinated by it and totally committed to it. And it was indeed a very infectious interest and commitment. All those who dealt with him caught the contagion and likewise became committed and interested in corporations law and commercial law. He was the founder and general editor of the Company and Securities Law Journal and the Australian Business Review, two very significant publications on Australian corporations and commercial law. He was also very, very active with the Law Council of Australia. heading the business law section. And he also published a marvellous publication as editor of the Baxt report. But he never stopped. He believed very firmly in connection between academic and scholarship study with business itself. He was appointed chairman of the Australian Trade Practices Commission, now the ACCC, and held that role from 1988 to 1991. The previous years before his appointment had been very turbulent years in the corporate world. He calmed things and made the law function so that it supported and assisted business, but with a very firm eye on the regulatory function. Through his career, Bob Baxt was awarded many honours. He was appointed Officer of the Order of Australia, the Centenary Medal, the very first honorary membership of the Law Council of Australia. He was awarded an honorary doctorate by Monash University and earlier an honorary doctorate by Griffith University. I want to make some remarks though now about the man who was the scholar, the teacher, the mentor, the expert, and the person. His scholarship, as I've broadly indicated, was extraordinary, with a very strong nexus with business and regulation. As a teacher, I can tell you, as an undergraduate at Monash Faculty of Law, Bob would be teaching taxation law and corporations law. There would be standing room only for his lectures. And indeed, many students in other streams would nevertheless come to Professor Baxt's lectures because they wanted to get what we might call the good oil. He was much loved by his students. Indeed, this is reflected in where the paths have gone for his students. They have become law partners, senior academics, barristers, senior counsel, judges of Supreme and Federal courts, and multiple Chief Justices. They have followed in his footsteps to become, including chair of the Australian Securities and Investments Commission and the ACCC. He took immense pride in where his students went. As a mentor, he continued and maintained a nurtured contact. He loved youth. He was always engaged. I recall, as Chief Justice, one of my functions was to preside over admission ceremonies for new lawyers. And every March or April, Bob would come along as an eminent practitioner to move the admissions of his graduate clerks. And I always remember with true humility, he would never allow my staff to place him in a position of prestige or honour. He always wanted to be just part of the legal crowd. As a person, he was warm, understated, engaged and engaging with a wonderful sense of humour. And I do recall whenever he could, he always had Ruth by his side. I am delighted that she joins us today. As an expert, I can recall when practicing as a barrister in difficult mergers and acquisition cases, senior counsel would often utter the catch cry, "Send for Bob." He was the expert they wanted to give the evidence in the trial. He was indeed one of Monash University's most eminent legal scholars. That has been recognised in the establishment of the Bob Baxt AO Chair, with, if I might say, the most appropriate inaugural chairholder, Professor Jennifer Hill, to whom I now hand over.
Professor Warren, thank you so much, and Dean Horrigan. I now have the very pleasant job of introducing our speaker for today, Professor John C. Coffey. I wrote an email to my colleagues at the Centre for Commercial Law and Regulatory Studies, CLARS, as we affectionately know it, the other day, where I described you, Professor Coffey, as inimitable. And I think that really does sum up your position in international corporate law and corporate governance. Those of you that have joined us today will know that Professor Coffey is the Adolph A. Burley Professor of Law at Columbia Law School. He's told me that good introductions are short introductions, so I'm not going to take you through all his achievements, but I would just say he has received numerous awards for his work in corporate law and governance over the years. He has been repeatedly listed by the National Law Journal as among the 100 most influential lawyers in America. And I also noted amongst your many, many awards, you received an award for your white-collar crime work. And that award was the Donald Cressy Award for Lifetime Achievement that was given by the Association of Certified Fraud Examiners. And I imagine they're a pretty tough group to impress. So, you know, well done. That is a great group to impress. Professor Coffey has written numerous books on securities law, corporations law, takeovers, the global financial crisis, and his most recent, which is a marvelous read, the 2020 book entitled Corporate Crime and Punishment, The Crisis of Under-Enforcement. And so for as long as I can remember as an academic, you have been very influential in tracking the shifts and, you know, shifting sands of corporate law around the world. And that is what you're going to do for us today, looking at some very shifting sands in relation to shareholder activism. So I'm going to pass over at this point to Professor Coffey. Thank you so much for joining us and for giving this inaugural address.
Well, thank you, Jennifer, for that very generous and slightly overstated words. If we get the full cartoon on the screen here, what I want to talk about, well, before I go into the merits of this discussion, I would be very remiss if I didn't also point out that I knew Bob Baxt. I was on panels with him. I met him several times on visits to Australia. I always found him energetic, dynamic, gregarious, and I think maybe a sense that he had some entrepreneurial flair in him. He could build things, he could create things, all of which is desirable. Now, I won't tell you about his career because you know much more than me, but I would make this one observation. If I was the president of a university and I wanted to appoint a dean of the law school who could help that law school evolve up from being a good law school to being one of the world's greater institutions, Bob Baxt is the sort of person that I would want to choose. And I would point out that over the last couple of years, I think that Monash has followed exactly that course, evolving into a much more significant and important institution. And there is no better proof of this, no better milestone than the fact that Jennifer Hill is now the Bob Baxt Professor of Law at Monash. From an American perspective, and here I am an expert, I can tell you what the American perspective is, there's probably no Australian law professor who is as well known and respected as Jennifer is. She's everywhere. She's on panels every time I turn around, and we're always delighted to see her and get her perspective. Now, with those opening observations concluded, let me turn to my topic. Shareholder activism is reaching a new level of intensity in the United States, but with new players and over new issues. It's almost as if the people who were quiet are now the activists, and the people who were the activists are now relatively quiet and on the sidelines. This is a departure from prior patterns, and I want to explain how things are changing and how things may play out, because I think we're all globally on the precipice of a new era of shareholder activism, one that's not focused on immediate short-term profit, but rather on whether or not the corporation can survive in a sustainable economy and help the world solve some of the problems of climate change, which are now getting increasingly serious. Okay. This cartoon is meant to reflect the dilemma. We all agree that the classic view is that corporate fiduciaries are supposed to maximize shareholder value. But what if maximizing shareholder value leads to environmental degradation? In this cartoon, we have a battered investment banker who's obviously been through hard times, trying to explain to the next generation, well, yes, we did destroy the planet, but for a beautiful moment in time, we've created a lot of value for shareholders. I'm not sure that's a complete justification, but that is the issue that's increasingly causing institutional investors to become more activists. Now here, let me take a step back and talk about the long history of institutional investors in American corporate governance. Traditionally, some institutions have always been activists, basically hedge funds and a few actively managed mutual funds, while other institutions were almost always seen as passive. The Typically, these were index funds, broadly diversified mutual funds, and most pension funds. Generally, the passive funds owned too many stocks to monitor. We could now sort of move up one slide. Eli, if we go up, okay. So we've seen there have been activist funds and passive funds, but it's just reversed in the last year or two. The passive funds, typically the big index funds, owe too many stocks to monitor individual firms closely, and their goal was only to match the market rather than beating the market. So they sought to compete by minimizing their costs, and because they sought to minimize their costs above all else, these funds tended to avoid any firm-specific interventions in their portfolio companies. But now, as of 2019, the assets under management at passive funds, index funds, and other broadly diversified funds, has for the first time exceeded the assets under management at actively managed funds. Passive funds, put simply, are now the biggest dude on Wall Street, and they walk with a certain swagger these days. More importantly, the institutional investors who are the most aggressive are pushing corporate managements to reduce their carbon footprints, to pursue racial and gender diversity, and these people are the people who once never got involved in firm-specific interventions. And even though they have 10,000 stocks in their portfolio, they do assert issues when it's a recurring issue. So while you won't get them to be involved in a specific question about what the company should do on a specific business issue, they are very ready to tell management what to do about climate change, racial diversity, board composition. What has happened? How far will they push the corporations to climate change or to curb negative externalities? How can they be encouraged to increase their level of activity? This is my topic when I'm going to give you a much too brief summary. If we go up one more slide. Now, why has there been this reversal so that the passive funds are now the activist funds? Once the passive funds were slow-moving giants, very reluctant activists, and now they're moving much faster than the hedge funds to support ESG. That's the first time I used ESG, so for one time I will say ESG stands for environmental, social, and governance, and in particular, focusing on efforts to curb climate change. There are two key forces driving this transition. We need to understand them. First, there's the issue of systematic risk. Being highly diversified and holding an enormous portfolio of securities, these so-called passive investors are principally interested in those risks that cannot be diversified away. These are defined as systematic risk, and there's no better example of such a risk than the uncertainties associated with climate change. So that's point one. You don't care about firm-specific issues because being fully diversified, that all washes out and you'll come out at average. But you do care about systematic risk because you can't protect yourself without taking special action. And the second change, even more important in terms of how it's changed corporate governance, is high common ownership. Because these diversified investors promise their investors that they will invest in the same indexes, they really can't compete owning the same stocks in terms of investment return, but only in terms of cost minimization. Holding the same stocks, they are going to have collectively a huge share of corporate share ownership. And in fact, the big three is a very well-known term that I'm going to now define. That's BlackRock, State Street, and Vanguard, now hold 23.5%, almost a quarter of the equity in S&P, which stands for Standard & Poor's companies. And this is predicted to rise to 30% or more shortly. So this is an extraordinary level of common ownership. What does that mean? Next slide, if we can. The implications of high common ownership are not only that these investors hold a close to de facto control block, but that they also have the ability to make decisions on the basis of the impact of a vote, not just on the stock they are voting on, but on their entire portfolio of securities. Imagine, for example, a hypothetical decision by such a diversified investor to elect directors favoring environmental or climate change restrictions. Now, that may hurt the portfolio company where they are voting, but it's also possible that by curbing pollution there at that externality causing company, you will be causing gains to your portfolio in all the companies that benefit from reduced pollution. Thus, you have this new trade-off, taking collective action to curb undesirable corporate behavior, that is, reducing negative externalities, makes sense so long as the gains to the investor's portfolio exceed the losses to the company imposing the externality. That comes down to this. We now can look at whether this is good for our portfolio, even if it's bad for the company whose shares we are voting. Now, this is true for and only for these greatly diversified investors. Hedge funds and smaller institutions cannot act in this fashion because they do not own portfolios that mimic and span the entire market. Only that allows them to net the gains and losses to the market as a whole. Okay, so as a result, diversified investors may have a rational incentive to curb misconduct, at least when it causes greater losses to their portfolio than it creates profits. Okay, to illustrate, we need illustration here. If Exxon will profit $10 billion by imposing pollution on others, but other companies in the portfolio will lose $20 billion because of that increased pollution, then a fully diversified investor should seek to halt such misbehavior because it will gain more at the other firms than it will lose at Exxon. This is a totally new source of enforcement, and it's something that's only been true for a very few years, and it rises if and to the extent the diversified investor will take a portfolio-wide perspective. Now, bottom line here, this is a little dark and hard to understand sometimes, but we have described a force that could cause misbehaving corporations to be forced to internalize their externalities under some conditions. But reality is always more complicated than theory, and let me move now from theory back to reality. Let's talk about the new versus the old activism. Traditionally, activists were hedge funds, and they initiated a campaign by crossing deliberately an ownership threshold, let's say 5% in the United States, which required that they file with the SEC a disclosure document called a 13D that would disclose their plans for the target in whom they had just acquired 5%. Frequently, these disclosures were deliberately framed to state that the activists wanted to sell off some divisions or the entire company, wanted to increase leverage, wanted to buy back stock, or wanted to change management. The market generally responded favorably to such a program, and the target stock would rise on average over a long period of time, somewhere between 6 and 8% on the day following these disclosures being filed with the SEC. Typically, the activist's next step was to demand board representation. And if the activist had assembled a wolf pack of fellow activists because he had leaked in advance his intents to them, the target management would usually be forced to agree. They had to give the activists some board seats because otherwise they could be humiliated and be thrown out of office if a large wolf pack of its allies had been assembled. All right. In overview, then, the activists will move quickly and realize or give up on its agenda within a year to at most 2 years, after which it'll take its profit and sell out its position. Next slide, please. That's the old activism. Now what I call the new activism or systemic risk activism is different. It is not triggered by the appearance of an outsider, an insurgent who wants to force management to make some kind of firm-specific changes. No, it's going to be a group of permanent shareholders who've always been there and who share high common ownership, and they'll basically be index funds and some large pension funds. And typically they'll pursue a strategy relating to climate change or some other ESG issue. These shareholders are diversified, often index funds, and they're not interested in any kind of firm-specific change. They want to reduce their exposure to systematic risk because they see their primary investment risk being climate change. Now, the proxy contest organizer, however, is not such an investor. This is because index investors do not wish to lead the campaign, even though their votes will decide it. And that's the catch-22 in this story. We have diversified institutions who have voting power, can decide the outcome, but for reasons I'll come to, never want to lead the contest. Okay. Now, the new board members they will elect will usually be committed to moving the company away from dirty energy to cleaner energy, to reduction of carbon emissions, and possibly to greater board and managerial diversity. But the critical issue is who can lead such a proxy campaign for index investors who do not want to lead it themselves. Now I want to give you an example, a very dramatic example from this year. This was the biggest news in US corporate governance this year. A very small and new hedge fund called Engine Number One, which was named after the firehouse right next to their headquarters in San Francisco, conducted and won a hotly contested proxy fight and elected 3 directors to ExxonMobil's corporate board over the bitter opposition of ExxonMobil. But this little hedge fund, Engine Number One, had only 250 million assets, and that was a peanut, and it held only a $50 million investment in ExxonMobil, or roughly it owned 0.02% of ExxonMobil's stock, a trivial number. The conventional wisdom was you better get over 10% before you even think of starting a proxy fight. Okay. Now, Exxon was somewhat vulnerable as a target because it had suffered a $22 billion loss in 2020. But Engine Number One's victory was the product really of institutional support. It got the largest pension funds and the big 3 to vote for it. Conversely, Exxon won a strong majority of the stock of retail shareholders of individuals. And Exxon had a large percentage of retail shareholders, but they were not enough to outvote the very big diversified investors who held probably over 70% of Exxon stock. Now, although Engine Number One won a big victory, it was a problematic victory because Exxon's stock price went up only some 11 cents over the week of Engine Number One's victory. Not enough to begin to cover Engine Number One's expense. Engine Number One, even though it was small, had allocated some 30 million to cover its proxy expenses, which was a big portion of its assets. So the bottom line question here that I want to turn to was this an epic victory or only a Pyrrhic victory? This is an important question that affects whether we'll see more such contests where, although you won, you may not have profited. Next slide, please. So can hedge funds lead systematic risk campaigns? Well, typically hedge funds make their profit when the target stock appreciates after their intervention and investment. But targets like ExxonMobil may decline in value precisely because a systematic risk campaign may restrict their behavior and keep them from engaging in profit maximizing activity that results in externalities. The result here is something of a mismatch. Hedge funds are not equipped to run a campaign that depresses the stock price. They get nothing out of that and they lose money. Who else could lead? Well, Engine Number One did not profit on its ExxonMobil investment, at least until later in the summer when oil prices rose dramatically, proving in part that Engine Number One had misjudged the market. Engine Number One did announce after this successful fight that it was creating an exchange-traded fund, an ETF, to run similar campaigns. Thus, Engine Number One may have profited through the favorable publicity it generated for itself. You can see this, if you want, as very expensive advertising that allowed them to sell exchange-traded funds to large investors. But such a strategy still seems problematic. Targets in climate risk campaigns are likely to see the discretion of the target curbed, reductions in carbon emission mandated, and their stock prices fall, and that's not good for a small hedge fund. Next slide. Now that leads us to the question, why won't index funds, who are huge, BlackRock is something like 30 or 40 trillion dollars under management. $1 trillion is a big number. Why won't index funds lead the proxy campaign? Well, index funds basically invest in the same indexes. They promise their shareholders, we're investing in the S&P 500 or we're investing in the Russell 2000. And this gives rise to a collective action problem. Because they're invested in the same stocks, they cannot outperform each other in terms of investment returns. And if one fund, this is the catch-22, if one fund expends resources on activism, it is basically assisting its competitors who free ride on its efforts. The one thing you don't want to do in any business is to benefit your competitors at your expense and with them free riding. Now, what's the answer here? It may be to devise cost-sharing agreements among the major diversified investors. But that may sound collusive to some, particularly when large investors are agreeing and they own hypothetically 30% of the stock among them, and there's going to be bitter controversy there. Now, unable to compete on investment funds, index funds have classically tried to cost minimize. That has inclined them to cut costs to the bones and never invest in activism. Thus, the current pattern is, this is only the current pattern, but the current pattern is they will vote against corporate management. They will even try to replace corporate management, but they will not expend funds on the proxy fight. And a typical proxy fight in the US costs the insurgent something like $10 million on average. That's not trivial. And in fact, the ExxonMobil campaign was budgeted by engine number one to cost it about $30 million. So that tells us the expense, and there's got to be a profit someplace to justify that expense. Okay, next slide. Okay. Now, a short-term solution, a partial solution, might be for the activists leading this campaign, including activist hedge funds, to demand that the target corporation reimburse the reasonable proxy expenses of the insurgent who's leading this proxy fight, at least when they are successful in securing board representation. This is permissible under US law, but it'll be resisted bitterly by target managements unless diversified investors will strongly support and insist on it. Today, most proxy contests are not won in the ballot box. They are instead anticipating the outcome of the ballot box. Both sides negotiate and resolve the contest before the vote is actually counted, because they both have a pretty good estimate of how the vote is coming in. And thus, management learned at Exxon that they had to fear this peanut-sized insurgent engine number one, which was actually able to defeat ExxonMobil by securing the support of the diversified investors. Now, for the long term, it is possible to imagine a number of specialized agents who could be created to lead proxy campaigns for diversified institutions, but this will require them to be able to put some money in to support their proxy campaign leader. The longer term answer, my last point here, the longer term answer may be for the big three to see the advantage in proxy activism and begin to assume its costs, which historically they have resisted. Today, they see only the cost and potential liability. Okay, go to the next slide. Now let me explain this in a little bit more detail. Index funds have taken the lead over actively managed mutual funds, convinced American retail investors that it's better and safer to invest their retirement savings in index funds than in actively managed mutual funds. Public pension funds probably also could be convinced to use index funds to manage a portion of their portfolio. A great marketing advantage is available here and is open to index funds and their advisors. The index funds have already convinced investors that it is safer to match the market than to try to beat the market. Okay, and that's proven by all kinds of empirical evidence. But imagine an index fund, a BlackRock or a State Street, that conducted a well-publicized campaign over climate risk issues. And now it advertises, here is our new policy: match the market and save the earth simultaneously. I think that's got some marketing appeal, particularly to retail investors who are well-heeled and want to do good things. Now, eventually, there's a possibility that the big three will abandon cost minimization as their focus and recognize that the first of them to go green will steal a march on its rivals and have a significant marketing advantage. And then maybe we'll see them assume costs. But that is still one step ahead of where we are today. Next slide. Okay, let me turn now to what regulators should do. And if I haven't yet raised your hackles, I may raise your hackles here. Today, most large US corporations publish an annual sustainability report. Some are published on a standalone basis, while some are incorporated into the regular SEC filings, the Form 10K, for example. Some of these firms attempt to comply with a framework established by standard setters, the best known of which are the Sustainability Accounting Standards Board, SASB, or the Task Force on Climate-Related Financial Disclosures, the TCFD, which is a fairly global body. But most just do it on their own and don't comply with other frameworks. The methodologies used as a result are highly inconsistent. Right now, there's a host of rating providers, over 200 in the US. They provide rankings and ratings as to your ESG posture, how good are you on ESG, based on entirely non-comparable criteria. As a result, we have confusion and the ratings are extraordinarily uncorrelated. That is, a big public company can be in the top quartile of one ratings provider's list of the top ESG rankings and in the bottom quartile of another provider's list, and both are doing what they think is the right way to rank firms on ESG criteria. This is a problem that can only be solved by regulators. And it's a problem that regulators are approaching, but approaching gingerly because they know it'll be controversial. Possibly regulators will wind up adopting some of the metrics from the TCFD's efforts, which has probably had the greatest level of support, but that's not going to be enough. Today, two comparable issuers can adopt metrics dealing with carbon emissions, and they both will believe they're in the same position, but in fact they are not. One deserves a high ranking, the other deserves a low ranking. The only way investors will have some control in this field is if they get comparable data, and they are not getting comparable data today. Next slide. The biggest problem, this is the longer term problem, auditing and assurance. Normally, a public corporation's results are audited by an independent auditing firm, okay, which is subject to potential liability if it misstates. But sustainability results are not audited. Thus, if a corporation promises to reduce its carbon emissions by 50% by a given date or by 100% by a later date, no independent third party will be certifying that it has or has not done so. Why? Well, it's nice to say we need an auditor here, but auditors do a limited thing. Auditors audit financial results of operations, not social, technological, or environmental data. But some means of insurance seem necessary. So if we look out for the next 5 years, the problem after determining what disclosures have to be made is determining what means of assurance can prove that those disclosures are accurate and that you are living up to your promises. This is a problem for the future, but it's going to become a very heated controversy within the next year to year or two. Potentially, auditors could rely on certification by technical experts who know how to compute carbon emissions. Again, this requires that regulators specify some metrics as a first step. Okay, the next slide. What happens next? Okay, regulators such as the SEC need to specify the climate risk disclosures that they will mandate. This has already been done to a considerable extent in Europe. They're quite ahead of the United States. In all likelihood, they will utilize some third-party standards, such as those already adopted by the SASB or by the Task Force on Climate-Related Financial Disclosures. But the big issue, the controversial issue here, on which blood may get shed, is to what degree securities regulators can go beyond traditional materiality standards in requiring new disclosures. This is where activists and corporate lawyers most disagree. In the US, the SEC actually does have statutory authority to require such disclosures, quote, as are necessary or appropriate for the proper protection of investors or to ensure fair dealing in this security. That's different language than simply materiality determines what you have to disclose, okay? That language allows the SEC to require disclosures that are not necessarily material if they think they're important for example, saving the planet. For example, the amount of greenhouse gases emitted by the issuer last year might be something that the SEC could try to force disclosure of, but it would take them beyond a classic materiality standard. Historically, the SEC has gone beyond the requirements of materiality in certain cases, most notably with respect to environmental liabilities, but they've always met bitter resistance, and I think that will happen again. My prediction is that we will see the SEC go beyond the materiality standard with respect to sustainability criteria, but each step beyond the materiality standard will be contested ground with the industry and the bar fighting a bitter last-ditch fight. Next slide. You'll be happy to see This is a conclusion. Everyone assumes today that enhanced climate change disclosures are looming and coming pretty quickly. We should see at least the SEC's first draft of these by the end of this year. Most assume that regulators will eventually attempt to specify metrics for these disclosures, because otherwise all we're getting is noise and confusion as people read these terms differently. But will regulators push beyond the materiality standard? There's no consensus, but I expect the SEC will. Regulatory action could go even further. Now, let me give you two examples to know what may come or what may be the battle line that will be fought between environmental activists and the corporate bar. There is an international body called the International Financial Reporting Standards Foundation, and it is the sponsor, the parent of the International Accounting Standards Board. That's the body that promulgates generally accepted accounting standards for most of the world. Now, this body, the parent, has created a sibling to the International Accounting Standards Board. This new body, which will be called the International Sustainability Standards Board, could promulgate generally accepted suitability standards that would have to be incorporated into regulatory filings alongside the issuer's presentation of financial information. And thus we would have generally accepted accounting principles and generally accepted suitability standards. This is the worst nightmare for the traditional corporate lawyer who wants to minimize such disclosure. Now, next regulatory action, eventually some objective body will have to audit sustainability information, ensuring that it complies with these new metrics. Here, the controversy may come the most heated, and I think that's still several years off. So let me summarize all this in a bottom line. Diversified investors, index funds in particular, are ready to push corporate managements and devote them out of office, but not yet to expend their own funds, okay? The question is, what will push them over that line to expend their own funds? And I think it has to be recognizing that there's a marketing advantage if you can go green and both offer a way of matching the market and also doing good. Doing good and doing well is always a popular strategy. Regulators have not yet taken a strong position on many of these issues, particularly the SEC, which spent the 4 years of President Trump denying that climate change existed. Okay. Now, however, they're going to be admitting that we have to have climate disclosures, increased climate disclosures, and the SEC has begun to monitor very closely the climate disclosures that companies are making this last couple of months. But we still have the need to see whether they'll be able to propose metrics, whether they'll be able to propose generally accepted sustainability standards, and whether the courts will back them up when they try. This is the fight that I think is going to dominate corporate governance over the next 2 years or so. And on that note, I think I've pretty much finished within my time range. Okay, I turn it over for questions.
You've been marvelous. I've just turned my video off. There we go. I'm on again. What a tour de force of the changes that are happening. And I know that we've got a lot of regulators in the audience today as well. So I'm sure they'll be very interested in your predictions. We're going to go over to the Q&A box now. Anyone who wants to follow by reading the questions themselves, you can just see them in the Q&A box. I'm also going to read them out. So our first question comes from Warren Scott at APRA. Hello, Warren. He asks the question, Professor Coffey, how effective is Larry Fink in setting the agenda in investment circles? So Larry Fink of BlackRock, is he really a leader or just an effective and loud follower? Any views on whether Larry Fink is setting the agenda here in investment circles, leading or following?
I think he's much more than a follower because he's got very strong criteria. Now, whether he will put his money where his mouth is still the open issue, but he has pushed on a number of areas, and he demands sustainability disclosures be made directly to BlackRock every year. Now, that's something others don't yet do. So he has questions that he sends to the large firms, and no one, if you manage something like 34 trillion in assets under management, you get listened to. Okay, so my answer is, I'm not saying that he's a visionary leader. He's nowhere as advanced. I think leadership is going to require people who can fill in the details, and that's bodies like this International Sustainability Standards body that's just been formed. or bodies like other similar metric setters. But there's no question that he will push for more compliance, and he's pretty explicit. He thinks the biggest investment risk they face is climate change, and the existing marketplace, in his view, has seriously underpriced it.
Thanks. Now, other people who the questions are now coming in, I should have mentioned for future people putting questions in, if you could just identify where you are from. But I'm going to ask the next question from Jonathan Taylor. What do you think will happen when the interests of shareholders addressing ESG diverge, where right now the interests are running parallel? Enhancing a corporation's ESG enhances its stock price. But surely there will be a time in the near future where focusing on ESG will hurt a corporation's profits. Well, that may also be happening now as well. This may happen across a number of passive funds portfolio companies. Do you think the fund will seek to address ESG to the same extent they are currently thinking of in relation to, say, Larry Fink's letter?
First part of that, tell me more if there's more to it later. The first part of it is, I've been explaining, there is this division among investors. Those who are stock pickers and who are not diversified may be very upset if you cause Exxon to give up on oil at a time when oil prices are now soaring through the skies. But if you are someone who has the whole market in the portfolio, remember the big three now own about 23.5% of the market and may own a few years 30%. So they're looking at the total market, and the stock picker may see prices go down on the stocks he's picked, whereas the diversified investor says, we own the whole market, and the whole market is going up because the gains from reducing pollution outweigh the losses. So I think we're going to have different kinds of investors having different attitudes. I think you may see activist investors who are stock pickers being in bitter disputes with the giant big three, but they don't come near the same size. We're talking about investors with trillions in their portfolios, whereas hedge funds may have 100 million in their, or a couple hundred million in their portfolio. So there will be conflicts, and of course there will be politics. I haven't really explained the most critical problems. Suppose I am three of these firms, three diversified investors own 30%, and they push through a vote that will curb climate change. And the result, which they foresaw, reduces the stock price of that company by 15%. Or make it 10%. Are they breaching their fiduciary duties? They are deliberately taking action that reduces the stock price of the company. Now, of course, that's what managements do all the time when they reject a tender offer. The tender offer may be at 50%, but they say that's not the long-term view. And I think we'll see the same conflict. The big three can say, we're taking a long-term view that unless you adjust to climate change, you'll be battered and decimated when climate change ultimately hits. But you are taking action that is contrary to the short-term valuation the market puts on that stock. And I think that at least in American corporate law, Delaware has long permitted you to take action that won't increase the stock price if you believe you're increasing its long-term stock value. So the issue has some of that, but depending on what you're doing, if you go on the board, you have a real problem in taking action that reduces the stock price. That's why I think we'll see all of these diversified investors appoint independent third parties as their independent directors. They won't put their own staff on the board. That gives you both an insider trading problem if you're a director of this company, and it gives you a problem about how can you push the stock price down when you are a director. So they will put retired CEOs from other firms, and that's what engine number one did. And I think that will be the primary pattern. But you're right that there will be bitterness and conflicts here.
I just might interject a question in relation to engine number one and Exxon. My recollection was they put up 4 directors, or maybe it was 3, and one of them did not get on. What was the difference between the directors that got on and the one that didn't?
The big three, which likes to show that they're independent, voted for 3 of the 4 nominees, but not the 4th. It was a decision made by the big three. The individual retail investors, individual shareholders, voted heavily for Exxon's nominees, but 3 of Exxon nominees lost, and the 4th only lost by a little bit. It was close.
Okay, our next question comes from Arthur Apos. Arthur's asking a question about collective action, and he says, the regulatory regime in Australia makes it difficult for large shareholders to coordinate or cooperate in relation to the affairs of a listed company. Is there not a similar impediment in the US? And I guess that relates to, hedge fund activism and wolf packs.
Well, what institutional investors have typically done in the US pursuant to a special proxy rule is you can indicate how you intend to vote. And a statement that only indicates how you intend to vote on an issue is free from any 10b5 or anti-fraud liability. So I don't know exactly what the Australian rule would be, but if you got into sharing the costs, that might look like a control kind of action. But if all you do is indicate how you intend to vote, and suddenly you see 3 firms owning 25% of the stock, indicating how they're voting, and management of the company who has just the opposite position only owns 7 or 8%, you got a pretty good guess how that election is going to come out. And at that point, you negotiate, because these cases do not go down to counting the ballots. You settle based on how you know the ballots are coming in.
Yeah. My colleague Tim Bowley and I have actually been doing some work on this in the Australian context, and it's interesting that in the Australian context, the institutional investors don't tend to cooperate directly. They tend to do it under the umbrella of industry organisations. Next question comes from Yu Zhang from Allens. You asked the question, given the portfolio approach you have described and the continued rise of institutional investors, do you see them using their power beyond enforcing ESG standards to, for example, anti-competitive reasons?
I missed the last 10 words. Just repeat the last 10.
Yes, could they go beyond ESG enforcement to get into the realm of anti-competitive kind of issues? And that, of course, is part of the common ownership debate. So if you could say a few about the risk of anti-competition.
Well, that was always the fear of economists, that once you got high concentrated ownership, they would try to cause companies not to compete. And there have been all kinds of studies of the US airline industry, where there are 4 airlines that dominate the market. And are they appointing officers that will be, or appointing directors who will try to cause them to compete less? There's been no definitive proof of this. I don't think there's been much good proof, but there's a huge debate among the antitrust bar and the antitrust academics. On the other hand, we're talking now about curbing pollution. And I don't think curbing pollution is a manner by which you are increasing your profits by reducing competition. I think it is something that is meant to benefit society generally. And I think that it would be hard to show how you secure a competitive advantage for yourself and your conspiratorial colleagues by reducing pollution or greenhouse emissions. So I don't think they sound similar, but I don't think they play out the same way.
Yeah, I think the point was just that this is for good reasons, but could it tip into a dark side? And that's a position that's quite important in Australia at the moment, because the government has got an inquiry into common ownership. Our next question comes from Michael Duffy. Michael says, do you think that the time horizons of investors are as short or shorter than politicians? So we're comparing investors with politicians in terms of time horizons. If investors' timelines are shorter, are they realistically likely to be part of the solution to climate change, particularly given that investors will have to take wealth losses now to avoid probably greater losses later?
Well, of course, I don't know anyone who has a shorter time horizon than politicians who are always looking to the next election. That's my somewhat cynical view. But when we talk about investors, again, there's a big cleavage between the firm-specific investor. Hedge funds have always been accused of having short-term perspectives, but the diversified investors don't care about short-term advantages in one stock because it all diversifies out. It all is going to balance out. Their focus is on how can we minimize systematic risk. If you have a fully diversified portfolio, you have only a secondary interest in firm-specific strategies. Your real interest is, how can I minimize what I'm still exposed to, which is systematic risk? And a pandemic may be systematic risk, climate change may be systematic risk, political and military change, those will all be systematic risk. I think that's what you see the large diversified institution doing. You don't see them. These are permanent shareholders. One factor that tends to suggest that the diversified institutions have a longer term horizon is that they are permanent shareholders. They never sell their stock. State Street says we own 10,000 stocks and we plan to keep owning those same 10,000 stocks. We may take action against management, but we're not planning to exit. That's because they want to hold the whole market. So I think if you're going to hold the whole market forever, you tend to have a longer term perspective.
Our next question is from an anonymous attendee asking for your prediction whether we will see the rise of ESG auditing firms. So going back to your point that we don't currently have much auditing of ESG matters, is that going to be a new market?
Well, there won't be accountants, because nothing in your training as an accountant gives you technological expertise on carbon emissions or greenhouse gases. I think that the accounting firms have shown a tremendous ability to become giant conglomerates and take on all kinds of other lines of businesses. I could see them setting up a subsidiary composed of experts who have PhDs and various kinds of biological and environmental science, and they would give specialized reports which the firm could incorporate, the auditing firm could incorporate in reference. So I think we will see, I won't call them auditors, but specialized sustainability experts. And maybe some will be independent, but I think more likely the big four has always wanted to maintain control, and I think they will probably try to set up subsidiaries.
Well, our next question from John Purcell asks whether there's any appetite in the US to break up the big four accounting firms to quarantine their audit from their consultancy functions. And John comes from CPA Australia.
Well, I would think that, yes, Elizabeth Warren and Bernie Sanders would like to break them up. They dominate about 5% or 10% of the political spectrum. The big four have tremendous lobbying resources. They are not under real threat, and they have succeeded in getting their securities laws changed so that it's quite hard to sue an accountant today. They have a number of protections ever since the Private Securities Litigation Reform Act. So I don't see them. The big four are under much more threat in England, the UK, and maybe also in Europe, and we've seen some firms indicted in several countries. One of the big four has been indicted in 2 or 3 countries. I'll be polite and not name it. But I think there is more of an attack on accountants generally outside the US than in the US.
Thank you. We now have Andrew Linden from RMIT. He asks, why would any investor that's genuinely interested in ESG invest a single dollar in ExxonMobil? Don't existing fund managers deserve more scrutiny for investing in sectors like oil and gas than any reasonable person for 15 to 20 years would never have invested in? So why aren't they divesting?
Well, I would say that if he believes that ESG is profitable, and there's a debate on that, he might say, I would like ExxonMobil to move in the direction of greater ESG activism, because that will move its stock price up. Remember that ExxonMobil lost $20 billion in 2020. That was a severe loss. Institutional investors had long been pushing it to diversify into other kinds of energy, solar, et cetera, wind. Exxon had been resisting. Now, the funny thing that's going on today is that the price of oil has skyrocketed, and Exxon is saying, see, we were right, because look, we are making more money with the price of oil going up. On the other hand, this board at ExxonMobil that has several groups of investors, it's got both the 3 elected by engine number 1 and others elected by other institutional investors earlier through negotiations. They are beginning to do a careful culling of all of Enron's big oil-related products. And this is the news last week in the Wall Street Journal that the Exxon board may compel management to drop a large number of projects. If you do that, and that's a movement in the ESG direction, and if you think ESG is profitable, that could be a good investment for you. You look at where the company's going rather than where it's been. On the other hand, the market right now is signaling that oil and coal for the short term are going to be very profitable in those countries that are poorest. Africa may be only able to afford coal, and that's a tragedy.
Thanks. Next question, Akshaya Kamanath, who is from Australian National University. Her question relates to climate change disclosures and whether they are truly effective as a regulatory technique to get corporations to act in an environmentally friendly manner. So what are the strengths and limits, I guess, of climate change disclosures?
It's not just environmental disclosures. It's electing directors who favor environmentally stronger measures. And that's what, of course, engine number one did. They didn't say disclose more. They said, we want you to diversify, and we want these directors on your board who are ready to make you diversify to wind and solar energy. And Exxon said, we've lost our shirt already on wind and solar, and we don't want to do it, but they're being pushed to do it. So I agree, disclosure alone doesn't force change, but disclosure plus board representation does. And I would also say, this is an old phrase in US corporate governance, you manage what you measure. If you start measuring your environmental consequences, you begin to measure it, you begin to manage it better so that you are less extreme. You don't want to be ranked last among the oil companies. So you begin to curb some things so you look like you're at least in the middle of the pack. The more you disclose what you are doing, the more I think you get pressure on management to at least move from the extreme side.
And that pressure also, of course, comes from the institutional investors. It reminds me very much of the 1990s with disclosure of executive pay. You know, it was there as a first step to greater pressure by the institutional investors. Phil Annersman, who I know you know and who was a great friend of Professor Baxt, he's in Toronto, I think, Phil, aren't you? And he asks the following question. In terms of the potential power of the big three, what downsides do you think it may raise?
Well, I think you could, if you're looking at one industry, then if you had a really oligopolistic industry, then you might get further pressure to reduce competition. Of course, management itself may want that also. Management also likes the quiet life rather than cutthroat competition. But there is this danger of reduced competition if you have very concentrated ownership. It's not just the big three. You could take the next three and they'd probably own 10%, and they could find, even if you broke up the big three, you could find more firms that could do this. If you're scared about this, let me point out, the answer is not to break up the big three. The answer is to tell the big three that they have to vote their shares as their beneficial owners instruct them. That would give you more protection from some kind of conspiratorial decision. I'm not sure you're going to see that many investors instruct the big three as to how to vote their shares, because the one thing we do know from the days of small shareholders, the old Bruley Means Corporation, is that ordinary shareholders tend to be rationally apathetic.
So our next question comes from Giuseppe Di Simone. And Giuseppe makes the point, again, I suppose, about divergence between different shareholders' interests. And he says he's a retired male with a minuscule share portfolio compared to Vanguard or BlackRock. His perspective is limited by his mortality and, you know, the period when he comes up for retirement. And is there a risk that the big three will face a concerted backlash to activist approaches by retirees who don't want a long-term approach, but who are approaching retirement?
Well, I'm not sure what it is the retiree wants. I don't know that there is a clear preference for or against ESG by retirees as a group. We know that retail shareholders tend to be loyal to any management, any company they've held stock in for a number of years. They tend to be loyal to management and management's preferences. But retail shareholders, let's look at the American pattern. If you are a New York Stock Exchange company, and if you're in, let's call it the Fortune 1000, it is likely that institutional shareholders own in the mid 70% of the stock. If you own in the mid 70% of the stock, those investors holding those shares, the big institutions, are going to dominate the small little investor. There's no way the little investors who add up together to maybe 22%, 23% of all the shares, they are a minority. They aren't going to be able to dominate. If you want to give where individuals might deserve greater rights would be the shares owned by large institutions, the BlackRocks, the big threes, are really retirement savings of individuals. And if you want to give greater rights, you might suggest that if investors were to instruct them how they want their shares voted, they would be required to try to vote beneficially, the shares of beneficial owners, in proportion to those instructions.
So the next question comes from Jonathan Hatch. Jonathan is with the ASIC Innovation Hub, and he asks for your thoughts on use of automated monitoring, ML or AI, to monitor claims around net zero or other climate change work. And he says, if there is that automated monitoring, in your view, what's the best way to do it effectively? Is it by effective disclosure or prosecution, or possibly both?
Well, I'm not sure what you prosecute anyone for. The fact that they expressed their views to each other and state opinions, we think this management is moving much too slow on climate change. I don't see what the crime is there.
No, I think it's more to do with the company announcing its ESG initiatives, and whether they're making statements. But I might be wrong on that, Jonathan. Apologies if I am.
I think securities fraud is focused on really ugly cases where companies have overstated their earnings or they're prematurely recognizing income. Those are the cases. We have this fascinating trial now in the US playing out called the Theranos trial, where a young woman billionaire is in a very, very deep hole right now. We'll see how it plays out. That's the kind of case that gets criminally prosecuted. I am not sure that your views about climate change produce genuine fraud. If you were to lie, that's why you want auditing. Rather than depend upon criminal prosecution or litigation, I would rather make my first line of defense some kind of updated, more sophisticated auditor who can actually monitor the statements being made about climate change and our progress towards it.
Our next question comes from John Fast, who I'll say a few words about at the end of this session. John asks the question, to what extent is this ESG, this enhanced ESG activism, a reaction to the sense that government has become dysfunctional and unresponsive to changes in community expectations in general and slow to regulate in this area? Is this a gap filler, this activism by the institutional investors?
Well, I think every country is different. If Donald Trump is president, I think everything is dysfunctional, and ordinary sensible investors are going to be very worried. I'm not sure. They may feel that Joe Biden is not moving quickly enough, or is paralyzed, or doesn't have the political majority he needs, but I don't know that they are particularly, they see a course of action they want to take as individuals. I think that there are lots of ethical investors out there. I don't know what percentage of the market is. It may be 20%. They are very interested in voting on a combination of financial return and ethical conduct. They certainly aren't a majority, but they are a significant block. And there are groups like ISSG that try to present to those investors recommendations for ethical investing. I suspect those people will go forward. I don't think it's changed recently that much. What's changed recently is the tremendous power that the big diversified investors have gotten, because what's really happened is that the American aging near retiree has decided to move his money from actively managed hedge funds or actively managed mutual funds to diversified investments, recognizing that it's safer to try to match the market than to beat the market. If there's one rule that you get from reading the economic finance literature on trading, it's that trading is hazardous to your wealth. Smoking is hazardous to your health. Trading is hazardous to your wealth. They're both about equally dangerous.
Bruce Dyer asks, if fossil fuel investments are driven from listed markets and sold to private investors, do you think that will advance the aim of reducing emissions over the medium and longer term?
That's a very good question, because what we are seeing now is a lot of publicly held funds, publicly held corporations, particularly European ones, are selling their controversial dirty assets to semi-public or smaller firms that aren't subject to the same kind of ethical shareholder pressure. The biggest oil district in the United States is something called the Permian Basin in Texas and New Mexico. And about 3 or 4 years ago, Shell Oil made a huge investment, 6 or 8 billion, buying up all the Permian Basin assets that it could. And it's just sold it 6 weeks ago, 3 or 4 weeks ago, to a small US firm because they are probably under pressure from European activists. The level of pressure is higher in Europe than in the United States. And Shell was under pressure to cut back on dirty energy. That doesn't mean dirty energy stops or goes silent. It just gets sold to an investor who might be able to hold it either in private equity form or in a corporation that has a founding shareholder and is less subject to shareholder pressure.
Jonathan Taylor, who is from the Australian Financial Complaints Authority, mentions that in 2015, the Big Three employed just a handful of staff to oversee their 10,000 plus portfolio companies. And that's certainly something that Lucian Bebchuk and Scott Hurst have written on. Do you think that this number will need to increase to make real change in ESG investing?
I'm not sure I got the question. You didn't print that out. So
sorry, it's still in the Q&A box. It's just about the fact that, you know, the big investors, BlackRock et al., they don't have many corporate governance employees. You know, Lucian Bebchuk and Scott Hurst have mentioned that, you know, they have, a negligible number of people in that area. Is that going to have to increase in relation to ESG?
Here is the basic debate. When Lucian Bebchuk's on a different side to me, Lucian believes that there is one remedy of everything: give shareholders more power. Other people think that shareholder primacy has to be compromised a little bit with sustainability. Now, Lucian has a number of articles in which he says if you tell managers to act in a more sustainable fashion, all they'll do is protect themselves from competition and from shareholder pressure. I don't think it's quite that simple, because we now have such concentration that the Big Three and others can force their will on these companies if they want. Now, you are right that they don't invest that much money in managing and monitoring their portfolio. I've been saying that all night, that the point of view of the diversified institution was to compete through cost minimization, not through investment returns. And if you're going to own the same indexes, you really can't compete in terms of investment returns. You all get the same returns. And if one person puts money into activism, he's really subsidizing his rivals because they get the benefit. Now, there may be some increased level of staff, but I haven't seen staff go up tremendously. It'd be an interesting question whether we can find that State Street and BlackRock are increasing the number of employees, because this pressure has been there. It didn't start yesterday. It's been there for several years, and we should see some increase in staffs. I'm not sure that they want to monitor anything about the firm-specific side. They want to measure and monitor basically systematic risk issues, of which climate change is the leading one. So if you see increased effort, it's likely to be on systematic risk issues rather than on all the firm-specific issues that other actively managed mutual funds tend to focus on.
I'm going to need to wrap things up now. Professor Coffey in New York, we couldn't have hoped for a better inaugural address. I know Ruth Baxt is there in the audience. Ruth, we're so pleased to have been able to share this with you today. We're so grateful to you, Professor Coffey, and it really was a fitting honour for Professor Bob Baxt. Thank you, everyone. Have a wonderful day.